The stock market has always been a battlefield. It's a place of high drama. Fortunes are won and lost in the blink of an eye. For generations, the warriors were human. They were traders, analysts, investors. They relied on instinct, research, a kind of street smarts you can't teach. The trading floor was a symphony of shouting voices, frantic hand signals, gut-wrenching decisions, a human game played by human rules driven by emotion. But the ground beneath Wall Street is shifting. A new player has entered, one that doesn't sleep, doesn't feel, doesn't blink. This new player is artificial intelligence, not a person in a suit, a web of algorithms on powerful servers. Algos, quant funds. Built to do one thing, make money. They process information at incomprehensible speed. The central question, who wins? Is the seasoned human trader, with years of experience and market intuition, obsolete? It's two philosophies of value. What does a human trader actually do? At its core, it's about making a prediction. A trader looks at a company and industry, the entire economy, and makes a bet on the future. They buy a stock believing it will go up, or they short a stock believing it will go down. Their tools are varied. They read financial statements, balance sheets, income reports to find clues about a company's health. They talk to people. They call up CEOs, industry experts, factory managers to get off-record info. They are part investigative journalist, part psychologist, trying to understand the story behind the numbers, the art of fundamental analysis. The greatest strength of a human trader is intuition, something an algorithm struggles to replicate. After years of watching markets rise and fall, a seasoned trader develops a gut feeling, an almost sixth sense for when things are about to shift. It's pattern recognition built from thousands of hours of experience. A human can sense fear in the market even when data looks stable. They can spot a charismatic CEO and bet on their vision, a qualitative factor a machine might completely miss. AI trading, at its simplest, is about using computers to make trading decisions, but honestly, it's far more than just a person typing orders into a machine. These systems, known as algorithmic trading systems, algos, operate on their own. They are given a set of rules and strategies, often developed by quantitative analysts or quants, and then let loose on the market. The most basic algos might follow simple instructions like, buy 100 shares of XYZ if its price drops below $50 and the overall market is up. But the AI used by major hedge funds today is infinitely more sophisticated. They use machine learning to constantly adapt and evolve their strategies. The primary weapon in the AI's arsenal is speed. An AI trader can execute a trade in a microsecond, a millionth of a second. This is the world of high-frequency trading. These systems are often located in data centers right next to the stock exchange's own servers to minimize the physical distance that data has to travel. They are fighting for advantages measured in nanoseconds. They don't care about a company's long-term vision or its CEO. They profit from tiny fleeting price discrepancies, executing millions of trades a day to skim fractions of a cent from each one. It's a volume game, and it's a game that no human can possibly play, executing its strategy with cold, hard, and often profitable logic, 24 hours a day. So, who is actually making more money? To answer this, we can't rely on anecdotes, we need to look at the data. The year 2024 provided a fascinating test case. The markets were choppy, influenced by shifting inflation data, geopolitical tensions. Let's look at the performance of top-tier hedge funds. According to industry data compiled by firms like Preek and Barclay Hedge, the results were stark. The top-performing category of hedge funds in 2024 was, overwhelmingly, the quantitative funds. These are the funds driven primarily by AI and by systematic computer models. The average return for the top quartile of quant funds was approximately 18.5% for the year. In contrast, the performance of traditional human-led discretionary funds was more muted. The average return for the top quartile of these human-centric funds hovered around 11.2% in 2024. Why the gap? A major factor was the market's rapid reaction to economic data releases. AI-driven funds were able to process inflation reports and Federal Reserve statements in milliseconds, repositioning their entire portfolios before most human traders had even finished reading the headlines. In a market driven by quick data-based reactions, the machines had a clear and demonstrable speed advantage. The human's thoughtful, narrative-driven approach was simply too slow to capture these fleeting opportunities. However, the data doesn't tell the whole story. While the top quant funds outperformed, the dispersion of returns was also wider. This means winners won big, and losing quant funds lost big. Human-led funds, while posting lower top-end returns, showed more consistency. The world of trading is filled with legends, brilliant victories and, well, some truly shocking collapses. On the human side, there's maybe no greater icon than Warren Buffett. His strategy, is the polar opposite of high-frequency AI trading. He doesn't really trade, he invests. He buys wonderful companies at a fair price and, get this, plans to hold them forever. He famously said, "Our favorite holding period is forever." His success comes from a deep human understanding of business models, management quality, long-term competitive advantages, things that are, honestly, incredibly tough to quantify. His multi-decade outperformance of the market is a testament to the power of human patience, wisdom, and conviction-based investing. But, well, human genius can also, lead to ruin. The story of Nick Leeson and the collapse of Barings Bank is a real cautionary tale. Leeson was a star trader who made these huge, unauthorized bets on the direction of the Japanese market. When the market moved against him, he hid his losses in a secret account. Fueled by ego and desperation, he doubled down again and again, hoping for some kind of miraculous recovery. His actions, driven by those very human emotions of fear and pride, ultimately bankrupted a 233-year-old bank. On the AI side, the godlike figure is James Simons, the mathematician who founded the quant fund Renaissance Technologies. Its flagship medallion fund is, perhaps, the greatest money-making machine in history, reportedly averaging returns of over 66% annually before fees for decades. The fund's strategy is a total black box, known only to a handful of PhDs. For human traders, the benefits are clear. The primary advantage is adaptability and the ability to handle true novelty. When a completely unprecedented event occurs, like a global pandemic, the invention of a revolutionary new technology, historical data, is of little use to an AI. A human, however, can use logic, creativity, parallel thinking to form a hypothesis about the future. However, the risks for human traders are deeply personal and psychological. The emotional toll of managing large sums of money is immense. The fear of losing and the greed for more can lead to irrational decisions. A trader can become overconfident after a winning streak or too timid after a loss. They are susceptible to cognitive biases, such as confirmation bias, where they only seek out information that supports their existing beliefs. Furthermore, humans are slow. For AI, the benefits are all about efficiency and scale. An AI can monitor thousands of securities simultaneously and execute strategies flawlessly, without emotion or fatigue. This allows funds to exploit tiny, transient inefficiencies at a massive scale, generating consistent profits from market noise that humans can't even perceive. The risks associated with AI trading are equally significant, but they are different. The biggest risk is a model failure. An AI is only as good as the data it was trained on and the model it uses. If market conditions change in a way that the model has never seen before, it can start making catastrophic errors. This is the black swan problem. Another major risk is overcrowding. So, after weighing the evidence, the data, and the legendary tales, who actually earns more? If we define earning more in the strictest sense, the highest percentage returns on a short-term, consistent basis in liquid markets, the victory in 2025 goes to AI. The sheer speed and data processing power of quantitative funds give them an undeniable edge in the day-to-day churn of the modern stock market. They are masters of harvesting profits from volatility and short-term price movements. The performance data from 2024, showing top quant funds outperforming their human counterparts, is a clear indicator of this trend. They win the battle of frequency and volume. The reason for this is structural. Modern markets are electronic and data-driven. The game has changed to favor the strengths of machines. Information travels at the speed of light, and the entities that can process and act on that information the fastest have a built-in advantage. Human cognition, for all its wonders, simply cannot compete on this temporal playing field. However, this victory comes with a huge asterisk. While AI wins the sprint, humans still have a powerful claim on the marathon, if we expand the definition of earning more to include long-term wealth creation. What does this ongoing battle mean for the future of finance? Instead, the future is coexistence and synthesis. They'll combine the strengths of both. This hybrid model, quantamental investing, is already the new standard. Backed by a powerful suite of AI tools, AI scans millions of data points, it flags anomalies, it identifies hidden trends. Human guides strategy, AI handles execution and deep analysis. Humans provide common sense. Humans provide creativity. Humans provide long-term vision. Humans backstop AI against flawed data and black swans. AI provides discipline, AI provides speed, AI provides computational power. The future belongs to the centaur, half human, half algorithm. So, what does all this mean for you, the individual person looking to invest your hard-earned money? The battle between AI and humans on Wall Street might seem distant and complex, but it provides a clear and practical lesson. Don't try to play a game you can't win. The practical advice: play the human game. Your greatest advantage is time horizon. AIs fight over pennies in a microsecond. You can think in years or decades. Start with a simple, low-cost index fund that tracks the S&P 500. Your personal knowledge is an edge. Bottom line, the rise of AI doesn't end human investing. It clarifies our role. The shocking truth: to win, refuse to play the machine's game.